The company that makes Roombas declared bankruptcy this weekend. iRobot has been struggling financially for years as their vacuums have been facing tough competition from foreign autonomous vacuums. Our next guest says this goes to show that not all technology pioneers will be successful because it's difficult to stop copycats. Let's get more on this now from David Dietze, Chief Investment Strategist at Dietze Wealth Management. David, thanks as always for joining us.
Good morning, Roger.
A very expensive lesson, I guess, or a good lesson if you're looking at inventing something and becoming famous. Make sure you do it right.
Well, absolutely. I mean, this company started out to great fanfare back in 2002 with its, pioneer autonomous robotic vacuum cleaner. And of course, the iRobot brand name there is Roomba really became synonymous with this innovative technology. And at one point, this company had a market cap very close to $4 billion.
Wow.
And even now still has the major market share in this country for that. But a series of missteps going back to when activists from private equity forced them to divest a defense division, which would have given them another area to diversify in. That shrunk their company a little bit. And then, of course, the demand post-COVID, when people were no longer staying 100% at home, plummeted. And of course, all sorts of key competitors from China are coming in with better technology. They're using LiDAR, and they're coming in with cheaper prices, and that's really eroded the share and profitability for this poor company.
So it's difficult to you have to diversify. What's the most important of all those things that you said that were brought to its downfall, or do they all matter? Are they all almost equally important?
So their downfall has been going on for a while. When they realized that they were going in the wrong direction, Amazon made a run at them, and they were going to pay about $1.4 billion for the company. But, investors always love merger and acquisition activity, but you got to look at what the regulators are saying. And both regulators on this side of the pond and on the other side of the pond had big thumbs down. And so Amazon backed away. They paid a $90 million fee to be able to walk away because they weren't going to get the regulatory approval. Then they incurred more debt, and things just continued to go downhill. What's interesting, though, Roger, is just as recently as 10 days ago, this stock rose 73% on news that President Trump was going to make a big robotic push in this country. And people without any regard to the amount of debt on the balance sheet or how that they were losing shares drove the company up saying, hey, the company has the name robot in it. Trump is behind the theme. Let's buy in. But of course, that is all for naught now.
All right. On that note, let's move on to a Christmas Santa Claus rally. Do you think it's in the cards this year?
I do. We were all watching the key event, which is going to be tomorrow, which is going to be the November jobs report. We've all been starved, including the Federal Reserve, for actual real-time data on how that all-important labor market is doing here. If it's actually 4.5% or more, I think the market actually might rally even further because it's going to open up the possibility for even more Fed rate cuts next year. If, on the other hand, it's perversely looks better than people are forecasting in the 4.4 or 4.5 area, then the market may well sell off here because the prospects for more monetary support next year will be diminished.
Interesting. And is there any factor that we had a kind of abnormal September, October, where traditionally we'd see the dip? We didn't really see it this year. Will that play in at all with this?
Exactly. Although there may have been a payback for most of November, the market didn't do well. And indeed, the Magnificent Seven and the NASDAQ actually lost in November, which is typically a good month. But of course, investors do have to keep in mind that the Santa Claus rally is technically the last 5 trading days of this month and the first 2 of the new year. 79% of the time since 1950 has been a positive experience for the market, and the average return is 1.3%. But as you point out, in September, October, the market did very well, even though those tend to be not the best months. So you really want to, investigate in your fundamentals at all times and not just look at the historical lore.
And as we head into the new year, you're looking at small as big, small caps.
I think what we're seeing, it may have already started, kind of a bit of a rotation out of the AI trade. I think for a number of reasons. One, of course, valuations are very, very high, but they're also seeing more competition. As you know, OpenAI thought they had the magic bullet for AI, but of course we've seen with Gemini from Google, the competition is very, very fierce, and with interest rates still low and likely to stay low, I think investors, instead of leaving the market, will rotate, and certainly valuations in the small cap area look very, very attractive. And if this economy stays on track, that's really going to be good news for domestically based companies and smaller ones.
And what might make some people hesitate, just before we go, moving to small caps?
Recession risk. You know, if the unemployment rate goes up a little bit, and that causes the Fed to be more generous, that's good. But if it starts to go up a lot, given that consumers are 70% of the economy here, if the job market starts to get really shaky, they're going to pull back on spending, and smaller companies with less resources, with a tendency to have more debt, and lots of them somewhat cyclical, could be hit hardest.
Okay, we're going to have to leave it there, but David, thank you as always for joining us.
Thank you, Roger.
David Dietze is Chief Investment Strategist at Dietze Wealth Management.